Today, global markets are moving under the weight of three powerful forces. A gold rally has pushed prices to their highest level in history. Artificial intelligence stocks are hitting new all-time highs, driven by corporate investment and investor optimism. And the United States Federal Reserve is facing mounting pressure to cut interest rates sooner than expected. This is the kind of convergence that reshapes portfolios, shifts market psychology, and creates both risk and opportunity. Gold is at the center of attention. Futures contracts have surged beyond previous records, setting a new benchmark for the precious metal. The spark came from an unexpected policy move: fresh United States tariffs on 1 kilogram gold bars, a large portion of which come from Switzerland. Tariffs on gold are rare. This one has rattled markets and injected sudden volatility into what is often seen as a stable store of value. The result is a wave of safe haven buying. Investors who fear geopolitical escalation, uncertainty in trade policy, and potential currency instability are moving quickly to lock in physical and paper gold positions. Gold-backed exchange-traded funds have seen their largest single-day inflow in months. Dealers are reporting strong retail demand, and central banks in emerging markets are rumored to be adding to reserves. This is not just a short-term speculative spike. It is part of a wider story about fear, inflation expectations, and wealth preservation in a policy environment that is shifting fast. Gold moves higher when investors expect the value of money to erode, or when they believe other asset classes carry too much risk. Right now, both of those conditions are in play. In parallel, interest rate expectations are changing. J.P. Morgan, one of the most influential voices in global finance, has just moved up its forecast for the first Federal Reserve rate cut to September. This is earlier than most analysts anticipated even a month ago. The reasons are clear. The U.S. labor market is showing signs of fatigue. Economic momentum is slowing. Political uncertainty is increasing. And the cost of servicing government and corporate debt is becoming a serious concern. These factors are pushing policymakers toward a more accommodative stance. Rate cuts, when they come, tend to lift equities, bonds, and sectors that are sensitive to the cost of capital. Growth-oriented technology companies, housing-related businesses, and high-yield credit markets often benefit first. But early and aggressive cuts also carry risk. If liquidity floods too quickly into the system, speculative excesses can develop, and asset bubbles can inflate before the real economy improves. That is why the timing and pace of these cuts will be watched so closely. While gold and rates are setting the macro tone, artificial intelligence is still the defining growth story of this market cycle. SoftBank's shares have surged more than 13% to an all-time high. The driver is a bold $30 billion investment in OpenAI, coupled with the launch of a massive data center initiative. This is not just another tech headline. It is a signal that one of the most aggressive and well-capitalized investment firms in the world is betting that the AI boom has years to run. Market reaction suggests that many investors agree. Institutional capital is pouring into AI infrastructure plays. Companies that design semiconductors, operate hyperscale data centers, or provide the cloud platforms that AI workloads require. For those already holding positions in these sectors, the rally is delivering significant returns. For those still on the sidelines, the question is whether the train has already left the station or whether we are still in the early chapters of the AI supercycle. There is, however, a geopolitical layer to this AI enthusiasm. The latest United States trade measures include a proposed 100% tariff on certain semiconductors and components. The aim is to push production onshore and reduce reliance on supply chains that run through strategic competitors. The effects are already visible. Taiwan Semiconductor, NVIDIA, European chip equipment makers, and other key players are reassessing production strategies. Tariffs raise costs, disrupt pricing models, and shift the balance between design, manufacturing, and distribution. They can hurt some companies, but they also create clear winners: domestic manufacturers, regional fabrication facilities, and suppliers who can offer compliant sourcing solutions. Markets are reacting in complex ways. Global equities are mixed but generally positive, helped by the growing belief that the Fed will turn more dovish. The US dollar is firm, reflecting a measure of confidence in relative American growth despite political and trade turbulence. Bond yields are moving lower, consistent with a market positioning for rate cuts. Commodity markets are lively. Beyond gold, energy metals such as lithium and copper are attracting speculative buying on expectations of supply constraints caused by new trade barriers. In an environment like this, investors need a clear strategy. One approach is the barbell, balancing defensive positions with high-growth opportunities. On one side, hold safe haven assets such as gold or gold-backed funds to protect against shocks. On the other, build exposure to high-conviction AI infrastructure plays, from semiconductor designers to data center operators and cloud platform providers. Complement these with selective positions in sectors that benefit directly from falling interest rates, utilities, real estate investment trusts, and growth-focused technology firms with strong balance sheets. The challenge now is agility. Tariff negotiations can shift quickly. Central bank policy pivots can happen between meetings. Corporate earnings can beat or miss expectations in ways that change the investment narrative overnight. This is a market that rewards those who can adapt, not just those who can predict. The bigger picture is that tariffs, technology, and monetary policy are no longer separate storylines. They are deeply interconnected. Trade policy affects supply chains. Supply chains affect technology development. Technology development drives productivity and economic growth, which in turn shapes central bank policy. Understanding this web is what separates reactive traders from strategic investors. We are entering a period where decisions made in Washington, Beijing, London, and Tokyo will ripple instantly through equity, bond, commodity, and currency markets. Investors who can read these signals and position ahead of the crowd will be in the best position to capture gains and protect capital. Subscribe to the AI Finance Mastermind channel and turn on notifications so you never miss an update on how artificial intelligence, finance, and global markets intersect. This content is for informational and educational purposes only. It is not financial advice, investment guidance, or a recommendation to buy or sell any security or asset. Always do your own research and consult a licensed financial advisor before making investment decisions.